Basically, this subject is all be going to be about the financial and management accounting techniques for the managers. That is, how managers are capable enough to use the financial techniques and management accounting as well. Now, these two things, like these two terms, are different subjects: financial accounting and managerial accounting or management accounting. These both are different subjects, but in your roadmap, it has been accumulated. So everything's going to be brief and to the point. So today, what we're going to discuss is I'll be discussing the compare and the management and financial accounting system. That is the start of your topic, and that's it. And slowly and gradually, we will be moving towards 1.2, 1M1, 1D1. In this way, everything is going to be clear enough to every student. And after every lecture, like in the next class, I'm going to ask the questions as well from the previous lecture. In this way, I will be knowing that whether you're engaged in the lecture or not. Because in the end, the assignments, they are all calculation based, specifically task 4 and 5. So I need your full participation as well. Clear, guys?
Yes, ma'am.
Okay, perfect. So the learning outcome one says understand the financial and management accounting system, and the AC 1.1 says that we have to compare these two terms. Now, the word compare, what this means according to the command verb, it says examine the subject in detail and looking at the similarities and differences. That is, we're going to define these terms in detail with the examples using different firms. It can be an SME or a multinational. And then we're going to discuss what are the similarities and differences, what makes them different or unique. So, what actually a management accounting is? It is referred as a managerial accounting as well, and is used by the managers and directors to make decisions regarding the daily operations of the company. That is, in an organization, whether it is an SME or even a home-based business or even a multinational, in a daily basis, we have to make the decisions. We are bound to take decisions in everyday life. And those decisions are specifically under the heading of managerial accounting. A distinguishing feature of the managerial accounting is that it is not based on the past performance, but on the current and future trends. So, what is, you can say, USP of this accounting, managerial one is, we don't look into the past data. However, in the financial accounting or the normal account, cost accounting and the cash flow accounting, we do use the past data. But in this, we don't use the past data. We only talk about the current, the present, and the future because we have to do the budgeting as well. So what is going to be present at the moment, we are going to take the decision according to it that what we will be getting a benefit in the future. For example, determining how much your business should charge for a new product, that is price. We have to determine price and we're going to do this according to our present time. And analyzing how much revenue a future product line is capable of generating. These both are examples of the business problems with the field of managerial accounting. Now, these are two diverse examples, and these are problems as well for the organizations. Why? Because it's not easy. If we talk about this inflated time in the world, everything is expensive. So the thing which was, for example, if it's 100 rupees, you cannot sell that product at the same price because the value has been increased. Clear?
Yes, ma'am.
Since businesses leaders constantly need to make operational decisions, in a short amount of time, management accounting must rely on predicting markets and future trends. Now, to sum up the management accounting or managerial one, it is all about what is happening at the moment and what's going to be happening in the future. And this is how a business runs. We have to see what our rival companies are doing, what our competitors are doing, and then we have to take the decisions on the time, and we will see the results in future. Then what is the financial accounting? Now, this is used to present the financial health of a company to the external stakeholders. Now, what are the external stakeholders? What's the question? All right. I was discussing about the external stakeholders. These are the people who help our business organization to grow exponentially in the terms of they buy shares from the company. And these are specifically the customers, the shareholders, the government, and the suppliers as well. Why they're interested in the financial health of the finance of the business? Because they are related to your business in terms because they have investment, like they have the investment in your business. So they are getting the returns on time or even not on time, but that is the reason why they're so linked to the financial health of the business. This allows the board of directors, stockholders, potential investors, creditors, and financial institutions to see how the company has performed during a specific period of time in the past. That is, on every 30th December, there is a statement of financial position that is called a balance sheet as well. Now, what's inside in it? It has current assets, non-current assets. Now, I know these terms are quite new to these students which are from the science background or from the computer students as well, the computer background. But with the passage of time, I will try to introduce these as much as possible in an elaborative way. Now, these reports are filed on an annual basis. That is, the income statement, which was previously known as profit and loss account, and the statement of financial position, which was previously called balance sheet. These are made on the annual basis. Like after every year, at the end of 30th December, these are presented in the AGM, that is the annual general meeting, which is held in the organization, so that board of directors, employees, outer bodies know what is happening and what has happened till now in this year. Okay, then if a business is considered publicly traded company on the stock market, the report must be made part of the public record. That is, this is happens in the stock exchange. Those companies are publicly listed. We can see their financial position statement, that is the balance sheet and the profit and loss income statements. Why? Because only then we are able to make a decision whether to invest, whether to buy in this company as in terms of shares or not. If the company is not financially liable, then why to invest in it? But this is how the market works. Sometimes what happens is the company which are not doing well in the stock market, they tends up to give more, what do we call it, return on the shareholders, on the shares. Why? Because this is the job of the brokers, the agents which are actually selling them. They make a chaos in the market that, okay, now in the next 15 days, this market is like this organization is going to be uproared. And what happened is people start to buy more and more shares. And in this way, what happens? The stock exchange of the specific company goes up. This is how the mechanism works. Then in the last, guys, do tell me that everything is clear. Because in this way, I will go on, and if any question comes, it can be jumbled up. Okay, thank you so much, Hamza. And lastly, in a financial accounting course, students learn how to prepare, read, and analyze financial statements, which I discussed, that is the balance sheet and the income statement. You guys are not going to make them, but I'll be introducing them to you. And in the assignment specifically, because that is the main goal, we have to do those. What we're going to do is we're going to make simple calculations. These are very normal calculations through the calculators, but it will take time. Thank you, Hera. Okay. Now coming towards the difference, that what was the basic question, compare, but we will discuss the similarities as well. There are two primary differences between the financial and the management accounting. The first difference is that the managerial accounting, again, management is managerial. If I use managerial, please abide with it. It is presented to a company's internal community, while financial is prepared for the external audience. Why? Because in financial accounting, we are specifically presenting our organization in the stock exchange if we wish to, or otherwise any organization can do this because they want investment in the company from the different investors. And the managerial one, we're specifically associated with the internal community because they have to do the daily, they have to take the daily decisions. That's the main difference and the reason behind it. Even though financial accounting is of great importance to the current and potential investors, the managerial accounting is necessary for the managers to make the current and future financial decisions for their business. So, this is the main crux of both of them. Both are going to make a decision for the future, obviously, and for the present as well. But financial one, they are going to use the past data, and only then they can make the amendments. But the managerial one, they are going to take the present decisions, and they'll be focusing on what is going to happen on the in the future. Then we have the second difference. It is the accounting is exact and must adhere to the generally accepted accounting principles. Now we have an ICI standards in accounts, international accounting systems, which we are not studying at the moment because we have a focus on the financial account. So this is the main thing which we use in the finance accounting. These are the standards set by the authorities which are residing in the abroad, and we are liable to use them. Not only we, all around the globe. All right, and then we have a while management accounting can be based off a guess or estimate, since most managers do not have time to the exact numbers by the time a decision needs to be made. Now you don't know that how many times a decision has to be made. For example, today we have the agreement with the supplier that they are going to supply us with this much raw material. But what happens next day? There is a transport, what do we call that? Strike. Yes. There is a strike going on. What happens? The business goes in fall, like an as in they don't abide with the future commitments. So they have to take the like opt within option B or option C. So these are the few differences between the financial and management, but there are further as well, which I'll be discussing one by one. Now, the differences start. First, I'll be discussing the managerial one. What is the objective of the management accounting? The main objective of the managerial accounting is to help management by providing information that is used to plan, set goals, and evaluate these goals. When we have these in our mind, that is planning, goal setting, and implementing those goals, that is what a daily decision maker can do. So this is what the managerial accounting do, and this is their main objective. The managerial accounting produces information that is used within the organization by the managers and the employees because it is associated with the internal audience. That is why it is only related to them. Managerial accounting reports are not legally required. That is because that is not requirement by us as a customer, as an external stakeholder, as government. We're not liable to ask them that what's your managerial accounting report? Like what's the update on it? That is the business of the own organization, whether to show it or not. Now, what's the focus of the managerial accounting? It is on the present and forecast for the future, which I discussed earlier as well. And then the format is informal and is on a per department company basis as needed. Now, what happens is it is not necessary that the managerial accounting format or the paper, the document, it depends on the department. Like it is their choice whether to make a managerial report in a departmental way or in an organizational way. That is up to the organization or the business. Then in reports are only used, like their reports are only used internally within the organization. So they are not subject to the legal requirements that financial accounts are. Because financial department is specifically going to present the data on the annual basis. But the managerial one, they don't. It depends on them when to or when not to share. And it is depending on the daily, weekly, or monthly basis. Now, these are the decisions which the managerial accounting department as an organization takes. It all depends on them. Whether they have to report the board of director on a daily basis. If it is a small business, then I think on a daily basis, and then weekly and monthly. I hope till now the differences must be clear about the managerial accounting, right? Then moving towards the other aspect that is financial accounting comparison. or the difference. Their objective is to disclose the end results of the business and the financial condition of the business on a particular date. And that particular date is the 30th of December. It's fixed for the income statement and for the financial position as well. Audience are the information that is used by the external parties, such as shareholders and lenders, because these are specifically for the external stakeholders, this balance sheet and the income statement. So these are required by them. Then their focus is on the history, that is the reports on the prior quarter or the year. That is, the statement, the financial positions are also made biannually or quarterly basis, but it should be from the previous year. Like as in we have to compare the both. What's the revenue in the previous year and what's the revenue right now? It basically helps the managers, the accounting managers, because it just lowers the burden on them. Financial accounts are reported in a specific format so that the different organizations can be easily compared. Uh, the format is same internationally if you use the GAAP or ICI. ICI standards, it is simple that in the income statement, we always use sales first, then cost of goods sold, and then we are able to find the gross profit, and then we subtract the expenses. I know these things must be like I'm talking something about an alien, but with the passage of time, I'll be making you learning of these things. And in the end, we are able to get the net profit, that is the overall profit of the organization. And this is how any company or any organization is able to get to know that what is their profit, value of the profit. Then rules in the financial accounting are prescribed by the standards such as GAAP or IFRS, that is International Financial Reporting Standards. These are the legal there are the legal requirements for the companies to follow financial accounting standards. Like on your own as an organization, you cannot do this. There are certain set rules and standards, or there are equations, these are ratios through which we're able to do this. Clear till now? And in the end, we have to report this on the duration, just as annually, semi-annually, that is called biannually as well. If in the future any question has been asked about biannually, that is called semi-annually, and quarterly and yearly. Auditors are linked to which accounts? In the financial management accounting, right? But by account, you mean in the balance sheet or the income statement? To my experience, I haven't dealt any auditor term in the balance sheet because when we do the balancing in the statement of financial position, we don't use any auditing team. They are payables. Any idea about this, Hamza? Because I think you work in a corporate sector as well, if I'm not wrong. Can you elaborate like where you like read this or saw in the experience? Yes. Now you have given the answer by your own self. Why the auditors are in the manager's account? Because they are the one which review your data, the financial accounts. Now clear? Now we will be discussing the similarities between the financial and the management accounting. I combine these both. The coexist to provide accounting information to the users. Obviously, in an organization, whatsoever it is, the finance and managerial, they go by it like side by side. We have to take the daily decisions as well, and we have to take the make the balance sheet and the rest of the things as well. Both accounting types will be responsible for generating financial reports. One can measure and determine the cost for various accounting periods, departments, and sections in both accounting types. Now, this depends on both of the terms, that is the finance and the managerial. Why? Because in every department, it is the requirement to make such document, and then the amalgamation is made, which is presented at the end of the year in the AGMs. Now, both of them collect and categorize accounting data in order to prepare financial reports. Because if I take example of the managerial accounting, in the managerial accounting, when we are taking the daily decisions, expenses going on, right? We are spending in the organization. So it should be recorded. Both systems utilize the same accounting concepts and practices for the cost accumulation and cost allocation. Now, these two terms are the accounting terms, and these are both used in the financial accounting as well and in the managerial as well. Because we, in both accounts, we are going to do the calculations and only then we are able to make the reports. Both practices require education and expertise in basic accounting. Now, I think you must be clear that first we have to opt for the basic accounts, which is not in your syllabus. And then we opt, like we go on the types, different branches of the accounts, which is financial, managerial, and then we have further as well. Okay, now I'll be discussing through the roadmap. Now, these things are included in your roadmap, the users. The first thing is the users, and then we have, I think, outputs. The data which I put it in is all from the internet. Okay, so the management accounting, the primary users of the management accounting information are the internal managers which are working in the organization, executives, stakeholders within the organization. That is everyone who is working inside the organization, even in the form of giving investment as well. They are going to take the decision. They have the authority to take the decisions. They use this information to make informed decisions, plan and control operations, and evaluate the performance because they are the one which are making the decision. So they know how to do the things. And then we have financial accounting. The primary users of financial accounting information are the external stakeholders, which include the investors, creditors, regulators, and other general public. Now, these are the people come under the external stakeholders when we are discussing the financial accounts. Other than those, external stakeholders are the consumers and the customers as well, and the government as well. They rely on this information to assess the financial health and performance of the organization because they have their means in it. They have investment in the organization, so they have the right to ask the questions as well. So these are the users according to the roadmap. Then we're coming towards the output. Now, what's the output of the management accounting? The output of the management accounting include the various management reports and analysis tailored to the specific needs of different departments and projects within the organization. Now, this depends on the departments of the various organizations that how they have made up their reports and things that they're going like decisions. They're the types of decisions which they're going to take in the managerial accounting. These reports provide detailed insight into the cost, to the budgeting. That is why this managerial accounting works on the present and the future data because they have to do budgets as well. Variances, performance measures, and forecast, that is the future measurements, helping the managers make strategic decisions. Now, strategic decisions are the one which are going to be for the longer term. You're going to take a decision right now, and it has an effect on in the longer term as well. Then we have financial accounting. The outputs of financial accounting consist of standardized financial statements. These are a balance sheet. The word which is like the stats which we use nowadays is the statement of financial position. Balance sheet is obsolete, as in people try to use the new word. Income statement is the new, the previous word was the profit and loss account. Then we have cash flow statement, which is specifically dealing in the cash. Okay, in the balance sheet, what is included is that is the statement of financial position. We have non-current assets, current assets, and we have current liabilities and non-current liabilities as well. In the income statement, we specifically deal in the sale, cost of goods sold, gross profit, expenses, and in the end, we come up with the net profit. And statement of changes in equity. It is also known as the owner's equity, and it is in detail accounting, that is the pure account, but we're not going to study at all, like this term only. These statements provide a snapshot of the organization's financial position and performance over a specific accounting period, which can be biannually, yearly, quarterly. which is used for the external stakeholders to assess the company's financial health because they're going to invest in it. So it's very necessary to invest in only those companies or organization there in which the financial health is nice. It sounds good. Then the other heading is monthly and quarterly accounts. Management accounting often provides more frequent and detailed reports, including monthly or even weekly updates to support internal decision making and operational control. I discussed this earlier as well. Financial accounting, it typically generates quarterly and annual financial statements. While some organizations will produce monthly financial reports, they are generally less detailed and comprehensive compared to the management accounting reports. Now, the organizations, small businesses specifically, they likely to tend make the reports on a monthly basis. But what happens is the data isn't accurate because you cannot take the next decision very quickly on it. It is going to be a very biased decision. It's a proven decision. So it's better to make quarterly or financial as in after yearly or annually, we can make this report statements and then we can take decision according to it. Then we have ratios. Management accounting has its own ratios and the other one, financial, has its own. But these both are the branches of accounts. In accounting, we use both all the ratios as an amalgamation. Return on investment. It measures the profitability of an investment relative to its cost. That is, for example, I'm starting a project and it costs me, for example, 200 rupees. Now, what's my investment? Investment should be always doubled. For instance, if we have some, for God's sake, any unfortunate scene in it, we hit a natural disaster or a calamity, what happens? We should have some back-end support, and that is going to always help us. It helps managers assess the effectiveness of the capital investment. That is, what is capital in terms of accounts? All the cash, all the machinery, these are under the capital. Then it tells you how much money you have made or lost. That is, whatever the profit is, or if you even not gain the profit, what the loss is on an investment or project after accounting for its cost. That is, after doing all the calculations, what is the amount left? Then it is till now clear, like any difficulty in this ratio. Then the return on investment is calculated by dividing the profit. Okay, thank you, Hera, as well. Is calculated by dividing the profit earned on investment by the cost of that investment. That is, whatever the profit I have earned on my business, that is on the whatever ABC business is, whatever the profit I have earned divided by the investment or the actual cost of that investment. That is how we calculate the ROI. And for instance, an investment, this is an example, investment with a profit of $100 and a cost of $100 would have an ROI of 1, that is 100% when expressed as a percentage. That's it. Then we have gross margin ratio. Now this is like a bit instance of the income statement. Income statement looks like this, and it has factors, or you can say terms, including these. Now this ratio compares the gross profit to the net sales, that is the total sales, showing the percentage of the sales revenue that covers the cost of goods sold. Now what this term means. Gross margin ratio is what? It is simply the sales revenue, that is the total sales in your organization, the revenue, that is more than the cost of goods sold. Revenue should be always higher than the cost of goods sold. That is what gross margin ratio is. Now, it is also known as the gross profit margin. It is a financial metric that measures a company's profitability by comparing its gross profit to its net sales. That is, what is your gross profit is and what is your total profit is. Gross profit is the limit, like you can say, half of your income statement, because it includes the sales, cost of goods sold, and then we are able to know that what our gross margin is. And after gross margin, what happened is gross profit is, we like subtract the expenses and then we're able to know that what our net profit, total profit is. Now, what happens? Okay, total revenue is this figure represents the gross sales from a particular product or sale or a service. Revenue and sales are the same. What cost of goods sold mean? This figure describes all the direct costs related to the production of that product or service. That is, whatever the cost was incurred in the making of a particular product X, that is going to be under the cost of goods sold. Direct costs include labor, raw material, and equipment. Now, whatever the cost of equipment was, whether it was a depreciated equipment, for example, it was not well, well as in it was not working properly, and you repaired it. Raw material, whatever the raw material, primary or secondary, was used to make that product, and the labor. Obviously, we are going to use the service labor as well and the normal labor, skilled and unskilled, basically. They do not include other costs like business administration expenses, marketing expenses, or the taxes. Now, these three terms are not included in the cost in specific gross margin ratio. Now, gross margin ratio equals to total revenue minus cost of goods sold and divided by the total revenue. This is how we are able to get the margin ratio. This produces a ratio that reflects whether or not a company is efficiently manufacturing its products offering. A high gross margin ratio indicates that is, what if the number goes higher than the 2? It's just an example. It means that the lower the product is often high end. It has a greater efficiency. It has achieved more efficiency while the making of the product. A lower gross margin efficiency is just a process that could be improved. That is, it requires more alteration to it. For example, imagine a shoe company that earns a profit of $28.7 million from the sales of its athletic sneakers. The company carries a cost of goods sold. Now, these are the scenario. It's a simple scenario, and we are only putting the numbers into the formula. Now, 28.7 million was what? It was the total gross profit, or you can say the total revenue of that company. And what we did is we subtracted with the goods sold. Now, goods sold were what? Cost of goods sold. We're subtracting with it and divided by the total revenue. And what we get is the profit margin, which is 32.9%. It indicates how efficiently a company produces and sells its products, because the value which we get is in a positive number, as in we don't get a negative value. For example, we are going to get a negative value when our total revenues are going to be less than the cost of goods sold. Then there is a possibility then we are going to have a weaker gross profit margin. Clear?
Yes, ma'am.
Okay. Then the last thing which we are going to cover in the management accounting, it is called the budget variance analysis. Sorry. It compares actual performance to the budgeted performance. That is what is happening at the moment and what is going to be happen in the future. Identifying areas where the actual result deviate from the plan expectations. For example, we expected that we are going to reach a sale of 200 amount, as in we are going to sell 200 products, but what happened isn't, we were only capable enough to sell 150 products. Budget variance analysis is concerned with the difference between the budgeted and the actual values of a given period of time. Now, it analyzes the variances for the specific products, customers, and vendors. You can monitor and improve the performance as well as catch potential problems early. Now, these are the specific USPs of this analysis. The more you break down your budget into individual items, the more useful the analysis will be. It's very easy when you budget your things into different parts. In this way, we are able to get the analysis and the calculation easily. Spreadsheet software like the Excel or Google Sheet can help you to do this efficiently and regularly. Why we prefer Excel or Google Sheets while making the budgets for any house or even calculating the results of the students? Because it's quite easy to use the variances, use the correct ratios and different tricks and tips are in the Excel sheet, basically in the app. And when a user uses it, it makes them easy to calculate things because it's in a form like we call it, it's in a grid form. The formula states budget value minus the actual value. Right. Then we have financial accounting. First one is the current ratio. The current ratio is a liquidity ratio. What liquidity means? Liquidity means how you can make things, how early or quickly you can make things into cash. That measure a company's ability to pay short-term obligations or those dues within 1 year. For example, we took a loan which we are going to pay in 1 or 2, 3 months. So this is what it's going to be under a current ratio. It's in a liquidity form. It tells investors and analysts how a company can maximize the current assets on its balance sheet or the statement of financial position to satisfy its current debt and other payable. Now, what that is, we're going to discuss that, I think, further as well. Any questions so far, guys?
No, ma'am, no questions.
Okay, thank you, Hamza. Then it tells investors, okay, we did this, and satisfy its current date and other payables. Okay, now how do we calculate the current ratio? Divides the current assets by the current liabilities, assessing the company's ability to meet the short-term obligation. A ratio above 1 indicates a company can cover its short-term debts. That is, if the value, when dividing the current assets over the current liabilities, comes in a positive manner, that is +1 or more than 1, this means our company is more liquid. We can easily pay the debt, the short-term debts, not the 5-year loans or 10-year loans. And if it's come in the negative, this means we're not capable enough to pay the loans. So how we are going to even touch the larger loans? Now, what current assets are? These are listed on the statement of financial position, including the cash, account receivable, inventory, and other current assets that are expected to be liquidated or turned into cash in less than 1 year. These are what current assets are. Cash, account receivables, anything which we are receiving. Current liabilities includes the account payable, wages, tax payable, short-term debts, and the current portion of the long-term debt. Now, these are what liabilities are that we have to pay. Liabilities are what that we have to pay. First, we are using their services, and what is happening, we are going to pay in the end. And for example, we can even take the example of the electricity. We are using at the moment, but we are going to pay the amount in the end of the month, of the previous month. And this is the formula and how we calculated current assets divided by the current liabilities. This is what a current ratio is. A debt to equity ratio is, it is how much debt a company has compared to its asset. Now, debt is what? Money borrowed by one party from another. For example, what happens is, and as an SME, what we do is we always borrow from the commercial banks. And this is what debt is. It is found by dividing a company's total debt by the total shareholder equity. Equity is whatever the owner's capital is. Owner own, what do we call it? Personal drawings, yes. Personal drawings. In simple words, I'm an owner of an ABC company. I have my own investment as well. So whatever the debt I have taken from an organization, from a bank, I'm going to divide by my own investment, which I am happily I wish to invest in my organization. A higher DE ratio means that the company may have a harder time covering its liabilities. Why? Because we're not paying on time. Already we are having a debt on our head. If we are not able to pay the short-term debts, then how we are going to cover the long-term debts? Divides the total debt by the shareholders' equity, indicating the proportion of financing providing by the debt and equity. It helps assess the company's financial leverage and risk. Now, debt to equity ratio is very important in accounts and the other branches of accounts as well, because it is the main, you can say, peak point of an organization. Whether they are going to be on a saturating period or they are going to be downfall. Then we have earning per share. This is a measure of a company's profitability, that how much your organization is liable or can maximize the profits. that is generate revenue, total sales. Now, this is calculated by dividing the quarterly or annual income, B minus the dividends, by the number of the outstanding stock shares. Now, what outstanding stock shares are? These are simply shares which refer to company's stock currently held by all its shareholders. I can be a shareholder of a company, you can be a shareholder of a company, anyone can be a shareholder of a company because it is just a piece of share paper on which we have done an investment. We bought that paper on an amount. Outstanding shares include share blocks held by the institutional investors and restricted shares owned by the company's officers and insiders. Now, when any organization which is listed on the stock exchange, they are liable enough to pay their shares. It can be to the preferred dividends as well, that is the people, like these are those customers, or you can say investees, which always gets the return first. They are the preferred one. Then we have the common shareholders as well. Then we have the general public holders as well. And the organization workers can also even buy the shares of your organization. Okay. These shares appear on a company's balance sheet under the capital stock, and then we do the calculation of EPS. The higher a company EPS is, the greater the profit and the value perceived by the investors. That is, we want that EPS should be high and high. Why? Because we're going to get more and more return. First, the preferred shareholders are going to get the return, and then the common one. Now it indicates how much money a company makes for each share of its stock and is a widely used metric for estimating corporate value. It basically depicts the value, the goodwill of the organization, where it stands in the stock exchange, in the stock market. A higher EPS indicates greater value because investors will pay more for a company's shares if they think the company has higher profits relative to its share price. That is, there is a price of a share, all right? We're buying it through we're giving money and we are getting the shares. But profits, those are very necessary as well. If the profits of an organization or the net profit are higher of any organization, this means the EPS is also going to be high. And we would love to get the shares of those organizations. Clear? The EPS as well?
Yes, ma'am.
Okay, thank you. Thank you, Hamza. And lastly, the management accounting or the managerial one focuses on providing the material internal information for a decision making, that is day-to-day decision making or even on a weekly basis, while financial accounting concentrates on generating standardized external financial statements, income and the balance sheet. The frequency and the level of detail in the reports differ between the two accounting systems. Obviously, both are different things. They deal in one aspect, that is accounts, but they have different perspective. And the useful ratio also serve distinct purposes for the managers and external stakeholders. Was the lecture clear? I mean, this was a very new thing for the science student and for the IT, but the students which were working in the organization, I believe they must have know-how of these terms. Thank you, Mr. Hamza. And these are the two references which I will be discussing in the task class. After completing 1.2, I'll be doing the task 1. And it's going to be the same, but everything, I'll be only discussing the format, the lay format, and how you're going to do it. Any questions? Okay, thank you so much, guys. Take care.
Thank you, ma'am.
Allah
Allah
Hafiz.
Hafiz, ma'am.